Again, Wayne Mackintosh here. I've just shown you all how a line of credit works and how you can save money by paying off your mortgage much quicker and by saving tens, if not hundreds of thousands of dollars of interest that you would normally pay the bank. For 28 years, I've been showing people how to pay off their mortgage using a line of credit. But as you might notice, I've put up a value of $600,000 on this house with a mortgage of only $250,000. What you have here is an awful lot of available equity, lazy equity, money buried under the mattress and you're not using it. You can put that money to work in a safe fashion, generate more wealth for your retirement, pay less income tax along the way, and accelerate the reduction of your own personal mortgage. Let me explain what I mean. With a line of credit, and any mortgage for that matter, you can borrow up to 80% of the value of your home. That's loan to value ratio. 80% of 600,000 equals 480,000. So your limit that you can borrow using a line of credit is 80%, and in this case, $480,000. As you can see, the mortgage is only $250,000. So what I'm going to do now is I'm going to separate the 480 from the 250 by putting account 1 and account 2. Limit on account 1, let's start off with $280,000. The mortgage is only $250,000, therefore we have a $30,000 buffer to start with, a safety net, money available to you if you need it. But the objective, of course, is to park all your income in, live on the bank's money for free, and reduce the principal as quick as possible. That's how you get ahead. If we've set the limit of $280,000 and we borrowed $480,000 representing 80% value, we still have $200,000 as a limit on account 2. That's the equity that you've now unlocked, and you can use that equity to create wealth. This is how people purchase investments such as investment property. If we want to purchase an investment property for, let's say, $500,000, we're going to need 20% deposit to purchase that house. 20% of $500,000 is $100,000. Where do we get that money from? Most people don't have it in the bank, but they have it in their lazy equity. We have a limit of $200,000. So if we take $100,000 from account 2 and put down a 20% deposit, the bank will lend you another 80%, being $400,000. House 500, 400 plus 100 equals 500. You've now purchased your first investment property. This house is now 100% financed using it, once again, an interest-only line of credit where the interest is calculated on the daily balance and charged monthly in arrears. Now, the advantage of using a line of credit for this purchase is that you still have $100,000 as a buffer or a safety net. So you haven't used all your money. You've left behind an awful lot of money for other opportunities that may come along or for safety. Now, smart investors always leave plenty of liquid cash in case of an emergency or another opportunity. You become a smart investor because you've only used $100,000 out of $200,000 out of account 2 to purchase your first investment property. Now remember stage 1, where you park all your income straight into your non-tax deductible and you live on the bank's money for free. Now we have extra income. Rent. and tax savings. The rent and the tax savings also get parked straight into your mortgage because the objective is to pay off the non-tax deductible as soon as possible. The more money that you put into your non-tax deductible mortgage being account 1, stage 1, the quicker you're going to pay off your mortgage and the less interest you're going to give the bank. All you have to do is pay the interest only on this investment property because this is a good debt. This is tax deductible. We're not trying to pay off a tax deductible debt while we have a non-tax deductible debt, which surely has to be the priority to pay off. So we pay the interest out of account 1 interest only. We don't try and pay this off, and every dollar that we capture by giving the bank less money comes off your non-tax deductible mortgage, and this is how you pay off a 25-year mortgage in 5, 6 or 7 years depending on your circumstances. We can help you create wealth. Investment property is a capital growth investment. A capital growth investment like shares or property achieve compound interest. Right now, the official cash rate in Australia is 0.1%, meaning that it would take 72 years, or even longer, even if it was 1%, it would take you 72 years to double your investment. But with the official cash rate being 0.1%, obviously bank savings accounts are paying you nothing. Term deposits are lucky to pay you 1.5%, meaning that your money is not working. You might as well put your money towards an investment that is going to achieve capital growth and help you have an awful lot more money come retirement. And in the meantime, we've identified the very best financial structure in the world. Every dollar from your income, every dollar from rent, every dollar that you now save in tax is designed to help you pay off your non-tax deductible mortgage as soon as possible.